Hi, good morning, everyone, and welcome to this month's Tobias Wealth Wisdom Chat. My name is Edgar Collado, and as you know, I'm the Chief Operating Officer, Chief Compliance Officer, among other hats here at Tobias. And I'm joined today by Matthew Sainholtz, who's one of our co-owners, as well as one of our senior financial advisors, and we're going to talk to you about required minimum distributions, or RMDs. Welcome, Matt, and thank you for joining us.
Thank you, Edgar. It's an exciting topic. We'll try to make it exciting. I'm not so sure it's exciting, but it's very important because, as we'll explore, there are many opportunities for planning, as well as potential IRS penalties if you're not working and using your RMDs, required minimum distributions, appropriately.
Right. So as we usually do, we'll start with just disclosures and a notice that the information we're presenting here is general and it's meant to be general in nature. It's not personalized investment advice, but if you have any specific questions on your situation and how RMDs or anything that we talk about might impact you, you should consult with your financial advisor or your tax professional. A quick introduction about Tobias Financial Advisors for those of you that don't know. We've been in the business for over 40 years. We were really proud and happy to celebrate our 40th year anniversary last year. We're what's called a fee-only registered investment advisor, and we manage currently actually over $550 million for a select group of clients. We work with high net worth individuals. We work with pension and profit sharing plans, and we're really proud of the team that we have with expertise not only in investments and financial planning, but tax as well. For those of you that may not be current clients, we do offer complimentary initial consultation. So if you're interested in that, feel free to give us a call and we'll be happy to schedule something. This is the March session of our monthly chat. Like I mentioned before, we're doing these every month, just getting information out there in another way, and we're really happy to be able to do this for you all. Last month, we spoke about 529 plans and some other college planning solutions. And if you missed that, there is a recording available. And if you're interested, just let us know. We'll be happy to send it to you. And then we have a couple of upcoming sessions. Next month, we'll be talking specifically about Roth IRAs and 401ks and what those are and how to leverage your employer retirement plan. And then in May, we're going to do a chat on what a fee-only real fiduciary advisor is and what that really means compared to working with an advisor that's not a fee-only real fiduciary. So just with that, let's go ahead and get started, Matt. I think the first question here for me anyway is, what is an RMD and why is it so important to even be talking about this?
Right. So the definition of RMD is required minimum distribution, and we will be referring to RMDs for short as we go through the webinar, but it does stand for required minimum distribution. And who's it required by? How is it a minimum distribution, and some of those details. What this program and information that we're putting out today is really for retirees and folks that are approaching age 72. At age 72, you have to begin taking distributions from your retirement accounts, otherwise known as required minimum distributions. The age used to be 70 and a half, but prior to the Secure Act, I guess that would have been at the end of 2019, that created new rules to push the new required start date to age 72. And really, it's just kind of the government, the United States government try to entices people to save for retirement, knowing that maybe Social Security shouldn't be or can't be your only income in retirement years. So they've encouraged through incentives through the tax structure to entice people to save early during their working years in order to have more money in retirement down the road. And so the incentive is traditionally in a traditional 401k setting, when you put money in, you save money on taxes. And that's all nice and good. And it does entice people to save for future retirement and give up that ability to spend that money today. So at some point, In the future, the government says, okay, well, we gave this benefit up front. We'd like to now, you can't have that benefit forever. We're going to require you to take some of that money out of your retirement account every year after age 72, because at that point, we assume that you're retired. And let's face it, Uncle Sam wants their hands on the pot. Once you take a distribution from the IRA or 401k, it is taxable income. So that's where the IRS and the tax man cometh, and that's when you take money out. But the theory is, in your working years, you put money in at a higher tax rate. So that means you're saving at a higher tax rate. In the future, you have to take the money out if you're not working. For most people, you're in a lower tax bracket in your retirement years. And so the whole idea of required minimum distributions is making sure that people spend their retirement money that the IRS incentivizes you to save, and the IRS now wants you to take it out so they can take their piece of the pie. And that is, in general, what a required minimum distribution is defined.
Thanks, Matt. And I know that we'll talk a little bit later about some of the strategies and kind of some of the advice that we give to our clients in terms of RMDs, because you do have to take out the minimum, right, at a certain point. But there's other planning options that you have. So I look forward to talking a little bit more about that later. So the RMD, being for retirement accounts, does it apply for all types of retirement accounts? Is it the same for a 401k as it is, for an IRA, like you mentioned, or are there any differences or things that people need to know about which accounts it applies to and which versus which it doesn't?
Right. So, yeah, so traditionally you can think about any retirement account, whether that be a 401k or an IRA, or maybe a simple plan through your employer, any employer sponsored plan, traditionally 401k, 403b, 457, you name it, all the numbers out there. But if you got a benefit while you put money into the account, those are the types of accounts that require a distribution at age 72. There are a few different nuances. Roth IRAs do not require a distribution unless you've inherited a Roth IRA, and we're going to save that topic for another day, or maybe later on in the presentation about inheriting IRAs and retirement accounts. But for this purposes, really, it's any type of retirement account that you put money into and got a tax deferred advantage by putting that money into that account. So traditional IRAs, 401ks, 403bs, we have a chart here on our slide here that has all this information about the different types of account.
So I guess that makes sense. And with Roth IRAs, which we'll talk about more at our next monthly chat, technically the money comes out tax-free, right? So there's no incentive really for the government to force you to take it out, because it's not like you're going to pay taxes on it. Whereas with some of the other tax-deferred options, they want you to take it out so that you can pay taxes on the distribution. So yeah, that makes a lot of sense.
Yeah.
So we hear RMDs are a big deal and they're really important. I know for us, we have a process internally to make sure that our clients are taking their RMDs and kind of running through all the calculations and everything every year. And we place a lot of emphasis on that. What's the big deal, I guess, right? What happens if I don't take the RMD when I'm supposed to, or if I don't take as much as I'm supposed to be taking?
Yeah, this is a big deal because it's one of the most stringent penalties the IRS demands and puts on people that do not take their RMD. It's actually 50% penalty. If you're supposed to take $10,000 and you didn't do it, they can assess a $5,000 penalty of the amount that you were supposed to take. And so that is something you want to be very careful about. It's one of the stiffest penalties on the IRS code. And it's really something that's easily avoidable. You really should be on top of it and really kind of managing your RMD requirements as that's just, unfortunately, that's just giving money away that you shouldn't have. And so that's why we really have to stay on top of it. We encourage all of our clients and friends and families to think about these RMDs, and we'll go into kind of the calculation and the timing of it. But that 50% penalty is just, it's really just a terrible engagement. There are ways, sometimes you might petition the IRS, but it's just a road, a path you don't want to go down you just want to stay far away to do it. So we want to be sure we're on top of it.
Yeah, and I guess from time to time, and I don't know historically if it's ever happened before, but I know last year, right, the IRS kind of gave people the option of not taking their money out of their retirement accounts, and it was driven primarily by the decline that we saw in the market. But I mean, are you aware of that ever happening before? I don't recall in history if that's ever been seen before,
No,
where they
that was
forgave.
a special rule with the COVID pandemic and the CARES Act passed by Congress. I don't recall having seen that ever before, so that was a special year for tax year 2020. Hopefully, we'll never see that again, actually.
That's a good point. And hopefully no one forgets to take the R&D or take less than they're supposed to and have to pay the 50% penalty. So let's go in a little bit into when we're supposed to take the R&D. I know there were some changes in the laws, like you mentioned recently, so it may be a little confusing to people as far as when they have to take it. And then there's also certain dates, on your birthday that are important. So maybe you can talk a little bit about that, Matt.
Sure. So previous to a couple years ago, the magical age was 70 and a half. The government pushed that back by a year and a half. So now the magical age is age 72 is when you're required to start taking distributions from your specific types of retirement accounts. So even that has some special rules involved. So the first thing is, okay, let's think about the age of the year you reach age 72. You're required to do a distribution for your age 72 year. But only in this first year of attaining age 72, there's a special rule. And this is where it can get kind of confusing, but we'll try our best to explain it. In your first year, the year you achieve age 72, you are able to take your first RMD all the way out till April 1st of the following year you turn age 72. That is your first required minimum distribution. There's no penalty to take it in the year you turn 72. It's just your option to defer it up until April 1st of the following year. If you do that, you also have to take your age 73 required minimum distribution in that same year that you took your 72 up to April 1st. So in effect, you could be taking two RMDs, required minimum distributions, in the year following age 72. And beyond that, then it gets into a normal pattern where you just take once a year and you're fine with that. And so that actually leads to some strategies. In that year you achieve 72. Perhaps you are in a high tax bracket that year because that's the year you're finally going to retire. You work all the way up to November, for example. And so you're still in a higher tax bracket in the year you turn age 72. So working with a financial planning professional, you strategize, you do some tax planning, you think about maybe let's defer that first one out to the following year up to take it before April 1st and just take two in your 72 and your 73 in the same year. So it comes down to kind of a tax planning strategic approach. For some people, you need the money and you just have to take it at age 72 that first year. But age 72 is the new magic number where we really have to start thinking about these types of approaches.
And then the RMD is taxed as ordinary income. So whatever tax bracket you're in, obviously at the federal or state level, if you have state tax, what you're saying is kind of look at, what bracket you think you're going to be in that year that you're going to turn 72. And if you think you're going to be in a lower tax bracket the following year, for whatever reason, lower income or some other things that impact your tax bracket, you might want to delay that and then just take 2 the following year.
Yeah, that's absolutely right. It just comes down to trying to figure out your tax situation, and we all know things change in the tax code, but that's the idea, is to obviously start thinking about this when you're age 72. There is a rule to get a little bit more into the details. If you are still working at age 72 and you have a 401k account with your employer, you do not have to take required minimum distributions if you're still working and it's a 401k account and you're not more than a 5% owner of that business. So you are have some flexibility if you're still working come age 72 for 401k accounts. But we've seen it in the past where people have a 401k account or a retirement plan through work, in addition to a traditional IRA. At age 72, even if you're still working on a traditional IRA account, you'll still have to take your required minimum distribution. So there are a lot of nuances. There are some different rules, but just remember, age 72 is really when you need to start thinking about it and start planning to take your first required minimum distribution.
And then after that, it's just you have to take it in the calendar year, and you could take it at any point, right? It doesn't have to be a lump sum. You can take it monthly or quarterly, whatever you need, but it just has to be taken in the calendar year.
That's correct. They could do it any frequency, periodically. You just mentioned just by December 31st of the calendar year, the full amount of your required minimum distribution has to be removed from your accounts.
All right, and then let's talk about how do you calculate the RMD? Is that something that anyone can do, or what all goes into the calculation?
Yeah, so that's the so we've talked about the required part, when it's required at age 72. So let's talk about the minimum part of this distribution. The minimum is a calculation. The IRS kind of sets different tables based upon their actuarial tables, life expectancy. Each person has their own life expectancy factor. And so you take your IRA or retirement account balance at the previous year ends as of December 31st, 2020, if we're in 2021 this year, and then you apply a life expectancy factor. So you divide your year-end account balance by your life expectancy factor, and that is your required minimum distribution. Most, you can do it on your own. There's calculators out on the internet that have the ability to calculate the minimum distribution. There are also the custodians that we work with, such as TD Ameritrade or Charles Schwab. Those types of institutions also help calculate your required minimum distribution. So it's not something that you should struggle with. You can reach out to us. You can reach out to your personal financial institution to help with the calculation. But it does involve finding the right life expectancy factor based upon your age and who the beneficiaries are on your accounts, and how that then determines which life table you use into the life expectancy factor.
Thanks, Matt. And then we have a couple of questions that we put on the slide here that are common, questions related to RMDs. The first one being, do I have to actually spend this money? You mentioned earlier that the IRS wants you to take the money out, obviously, so they can get their taxes, and hopefully you're spending it, but is there a requirement to spend it?
No, not at all. We have plenty of clients and folks we work with who will just take their required minimum distribution out of a retirement account and just move that into another brokerage account or a taxable account, maybe an individual or a joint investment account. So there's no requirement what you have to do with it. They just want to take it out of the account, report it on your tax return, and then you can are free to do with it to save it for the future again, or use it how you see fit. So that's an important question, because sometimes when we've bridged the subject with our clients, and for the first time, they're coming up on age 72, and they look at it and say, I don't, I'd rather just keep investing it. I don't need the money right now. So that's what we typically set up with them, is some sort of brokerage account where they can continue to invest, but it's not in a tax deferred retirement account vehicle.
And do you have to take the RMD in cash, or can you do like an in-kind distribution, like for so not, I guess because maybe I have some stock that I really like in my IRA and I don't want to sell it and then buy it. I'd rather just move it. Can I do that?
No, unfortunately, you can't. You have to sell that particular stock or fund, make the distribution, and then if you put it into an investment account, which we just talked about, you could then invest that money into the same fund or the same stock or the same type of investment. But it cannot be in kind. It needs to be a cash distribution.
Great. So what if someone has multiple retirement accounts? Maybe they have an IRA at TD, maybe they have one at Schwab, or a 401k, that they haven't rolled over, that's, they're not working anymore, but they still have a 401k out there, or maybe even multiple 401ks or other retirement plans. How does that work in terms of taking the RMD, for all those accounts?
Yeah, that's really good to have working with a financial professional to help coordinate all your different types of accounts, because each account has a required minimum distribution. Like you mentioned, you might have an account here or there, wherever it may be. Each of those accounts has a calculated required minimum distribution. However, you do not have to take from each of the accounts. You could actually say, okay, my calculation across my 3 accounts, I have to take $20,000 this year. I'm going to take it from my 401k because the investment options aren't that great in my 401k, or maybe there's high costs. Again, that'll be up to you to kind of analyze and determine which account you'd like to take from. But we are able to satisfy all of your RMDs out of one account if that is prudent and the right way for your personal situation.
If I have like an annuity retirement account, do those also require RMDs? And I guess, would you just kind of lump that together with more traditional type of retirement accounts?
Yeah, there are certain annuities that are qualified annuities, which are similar to an IRA account or retirement plan. So those qualified type of annuities do have a required minimum distribution calculation. And again, you could take it from that account, working with your annuity company, or we could aggregate that, take it out of say an individual IRA account. So there's some planning there too as well, because sometimes if you take from an annuity that might have some different riders or bells and whistles, that could have a detriment to that annuity. And so you really got to make sure that you're really looking at all the different types of accounts. And that's where people get in trouble, Edgar. I mean, really, is where they miss and hit that 50% penalty, is because they have accounts all over the place, and they're not really have a simplified approach as far as administrating all these accounts. And as you can imagine, if you have 5 or 10 accounts at different institutions, it can be very easily to forget one. And that's why we like to kind of keep things consolidated and coordinated approach to comprehensive financial planning.
Yeah, that makes sense. So let's actually talk about some of the different options that someone might have, with the RMD. I mean, I know there's some people out there that, like you said before, might rely on the RMDs, right, as part of their kind of living income, and there may be others that don't need that because they have income coming from somewhere else. So what are some of the strategies and things that people can do, in regards to the RMD, either to, not take it or maybe save taxes?
Yeah, so we have a lot of different opportunities for strategic approaches to the RMDs. And I'm not going to go through each one of these. That would be a whole nother lesson here. But for couples, you might want to play between different couples accounts, and in the contribution years, maybe you want to fund the younger spouse's retirement accounts more, if you have to make a choice, who should you fund more, the younger person, the older person? It might be the younger spouse, because then you're not required to take distributions as fast. There's different ways. I mentioned if you're still working and it's a retirement plan, 401k type of retirement plan through your employer, and you're still working and not a 5% owner of that company, you might want to roll up your IRA into that 401k, and that would do away with having to take money out while you're still working. That's a pretty interesting strategy where if the fact pattern sets up just right, you can actually be over 72, continue to work and not have to take money out of your 401k type of retirement accounts. Acceleration of distributions from your IRAs. Maybe you find yourself in a year with a lot of medical deductions, and you decide before year end that, yeah, your required amount's only $20,000, but because the way your tax plan is setting up, you're going to take $100,000 out because you have high deductions that year, which will mask the income. And so that would be in the form of a Roth conversion. And that would then, obviously, when you take money out in a big lump sum of your IRA, that lowers your future required minimum distributions. Very, very advanced planning and very strategic. That has helped a lot of families that we worked with in the past. And then a final way to kind of do something good with your IRA distributions, your required minimum distributions, is actually called a qualified charitable distribution, and that is taking money out of your IRA and giving it directly to charity.
I think we're going to talk more about that on the next slide, Matt, because it definitely is something that we do for a lot of our clients as a good solution, in those cases where you may not need the R&D.
Right. So to just kind of keep it very high level and straightforward example, if you had two choices of what to do, to take money out of your IRA account and then give it to charity versus taking the money straight from your IRA account and giving it directly to charity, there's a nuance there, and it's definitely a better way to give the money directly from your IRA to the charity in the form of a QCD, another three-letter abbreviation. QCD is qualified charitable distribution. So just real quick on the traditional IRA withdrawal, you take the money out, you have to report your income to Uncle Sam, $10,000, and the idea is then that you have to pay taxes on it, and then you turn around and give it to charity. So there's a more efficient way of doing this, and that is the qualified charitable distribution. If you just take money out of your IRA, in this example, $10,000, you hand it over to the charity, you pay no taxes on that $10,000. You don't have to report it on your tax return. It's a more efficient way, it's a more tax effective way to be able to donate to charities that you want to love and support, and that is another way to do good while planning for your future.
Now we have a couple of minutes left and a couple of questions as well that have come in. So let's see if we can answer a few of those. One question was specific to inherited IRAs and inherited Roth IRAs. And I know you mentioned that a little briefly earlier, but what are some of the key differences? If you inherit an IRA, let's say from your parents, who may have or may have not been taking distributions.
Yeah. So the old age 72 rule is not effective here. It doesn't come into play. No matter if you're 40 or 60 and you inherit a traditional IRA, there is a requirement under today's law that you have to distribute that money within 10 years of inheriting that retirement account. And those are, you could do it annually over the 10 years, you could do it in one lump sum, but those are required minimum distributions. Prior to, let's say, I think it was 2020, the Secure Act. Prior to that, if you did inherit an IRA, a traditional IRA, you did have to take out It could be over the course of your lifetime, a required minimum amount, which we still have a lot of clients that have those types of accounts that will continue to take required minimum distributions out of their inherited accounts. And for Roth accounts, it's the same thing. For a Roth account that you own, that your name is on it, you do not have to take required minimum distributions. But if you inherit a Roth account and it is titled like inherited Roth IRA for the benefit of you personally, there are some requirements. You either take a required minimum distribution or that 10-year rule. And so when you inherit accounts, you have to be just as particular, because guess what, Edgar? If you don't take the required minimum distribution, you get a 50% tax penalty from the IRS.
Wow. Well, thanks, Matt. So I want to be respectful of your time, Matt, and everyone else's time today. I want to thank you for sharing your information and your knowledge on RMDs. Like you mentioned, probably not the most exciting topic in the world, but something that carries a 50% penalty is definitely something that people need to be aware of and managing correctly. So we did get a couple of other questions. I'll share them with you, Matt, afterwards, and if you can reply back to those folks, that would be great. So thanks again, Matt. Thank you, everyone, for joining us today, and we hope you enjoy the rest of your week.
Thank you.